All right, so you hear a lot about hard money loans, and sometimes they come with a bad rap. Shouldn't at all. In fact, they're a great financial instrument. When you think hard money, you probably think something like Tony Soprano showing up with a suitcase full of millions of dollars. Not the case. In fact, it's a financial instrument for anybody who needs more creative financing, common sense financing, situational lending, you'll hear it called. So we wanted to dive in a little bit deeper that if you were ever getting into real estate investing, what it means to you, and also what are some of the legal sides of this stuff. So no one better to talk about this than our good friend AJ Gupta and Ted Przybylek, first time on the show. You're the president of Rancho Ted with Real Estate Loan Investments. Good to have you on the show as well.
Yeah, thanks for having me.
So is that kind of true on the hard money stuff? You feel like, all right, that means I brought my baseball bat and we're going to get you some cash, right?
Well, we can have the guy that was on here earlier.
No kidding. The crippler Chris Levin.
We can go hire him to collect some money. So this is a common thing in our industry as far as needing money quickly, where there's a piece of real estate. Sometimes there's an event, a foreclosure that's coming, a particular event with a business where they need liquidity, and they have a real estate that may have some equity in it, or that they can refinance through a private money lender. And Ted's my go-to guy, so I thought I'd invite him along, talk a little bit about what he does and how he can help people, and then maybe transition into some of the good and the bad and the pitfalls. And
yeah, we got to be careful with it. So it's like anything. I mean, whether we're talking about hard money financing or even conventional financing or reverse mortgage or anything along those lines, if it's not administered the right way, if you don't have someone who knows what they're doing, it can be bad for you. And a lot of people get steered in the wrong direction. So that's with anything. But Ted, good to have you here. So help us better understand how it works and the situations that it makes sense and how you can leverage it.
Sure. We basically lend on equity, but we do look at people's credit and income. But I'll give you a really good example. I had a friend who was buying a property in Point Loma. It was a conventional loan they were doing. Halfway through the loan, the bank turned them down for some deposits they made that I guess they wouldn't accept. I guess they received some money from my brother-in-law and they wouldn't take it. So it's 14 days left in the sale, and we had to step in and close the deal for them. Otherwise, they wouldn't have got the property.
So when you say equity, a lot of times when people hear equity, they're thinking, well, I own a home and I owe this much and it's worth this much. But the story you just told is actually referencing a purchase. So here's somebody who's putting money down.
Right.
That's plenty of money. But the conventional financing standards say, well, you don't fit in our box, which is pretty tight. It's loosened up a little bit over the last year or so, but it's pretty tight. Either you fit in that box or you don't. So what you guys are able to do is you're able to look at the overall situation from a common sense standpoint. And the truth is, and correct me if I'm wrong, but the reason that you're willing to lend when there's equity was because there's plenty of collateral there for you.
That's right.
So before anyone starts getting terrified, I just watched the movie The Big Short the other day, that there's subprime loans. It's not that. You guys are lending in a situation where the collateral is pretty safe. Is that fair?
That's correct. We lend up to 65% loan to value. So that would be if you have $1 million property, we'd lend $650,000. So the investor has protection if something goes wrong and make sure they don't lose their investment.
So you might have somebody who has a little bit of a sticky situation in their past, whether some sort of credit issue, but you have enough money to put down, skin in the game.
Sure.
But also, again, it's collateral that protects the end-all investor. So if you foreclose on the property, well, that's bad no matter how you bought the house, but it protects you and the marketplace. Right?
What I was surprised to learn is how low the interest rates actually are. So I mean,
so usually there's a rate adjustment upwards when you do something like this. Okay.
So conventional financing, you'd think 4 or 5%, maybe 3-4% with some of the guys that come onto here and talk. But when I was talking with Ted, and it was surprised to learn that you can get private money for around 8%. I mean.
Yeah, it was up to 12 and then just keeps dropping to 11, 10, 9, and I've been getting some loans done at 8%, which is pretty good.
So relatively competitive rates. Now I know it's not the 4% you see quoted on online or anything like that, but that's the point. That's why it's a riskier loan to be made, but it's also safe on the collateral side.
Correct.
And something to keep in mind is as those issues, like for example, you have the money down, but you didn't have self-employment long enough, so the conventional banks aren't going to do anything with you. Well, you might be able to refinance down the road as well. That's good food for thought. So tying the legal side, one of the things you said to me when we first met years ago, AJ, was that nobody should go into a real estate transaction just on the advice of the realtor on the buyer or seller side, because there's a commission incentive. When you're talking about something like hard money lending. Give us some legal advice around all this and how you advise people that get involved with this stuff.
So, broad strokes, I think there's about 3 different categories of people that get into this situation, or not situation, but that require private money. And the first are investors. So if you're buying and flipping homes, you may need liquidity in the short run. You may have your money tied up in a particular investment. And the term is bridge financing. These can be anywhere from 2 months to a year and a half to 2 years. So those guys kind of know what they're doing. I think that's fine. And I've represented both lenders and borrowers in these lawsuits. But so you have the flippers, you have the business owner who has a piece of property that needs money quickly to make payroll, to do something that he otherwise wouldn't have been able to do. So that's a very common situation, that he happens to have real property. And then the one that I think that most people fall into, and these are the calls that I get from the consumer side, are the borrowers that really were facing with some imminent threat of foreclosure or some need, whether it's personal or professional, and they got into a situation without understanding. And these are the people that really do need to understand. They need to have a professional on their side. So, and unfortunately, these are the ones that have the least money to pay for it. But these are the people that tend to call to feel like they're being taken advantage of on the back end when there is a foreclosure event. And so, the term of art there is predatory lending, right?
Yeah.
So the feeling from
Which
the consumer.
We did see, back up to 2008.
Yeah.
Plenty of that.
Plenty of it.
And that there's big bank predatory lending, and then there's hard money predatory lending, or private money predatory lending. And the typical fact pattern is where the feeling is that the lender came in with no intention of actually getting repaid his loan plus interest, but wanted the asset itself. And they wanted the asset for some particular alternative scheme. So. And like, we were involved in litigation for about 2 years with, on a business owner borrowed some money. I mean, he put $1 million into this place and he borrowed $100,000. And the lender was trying to accuse him after a year of non-monetary default and trying to foreclose on him.
What does that even mean?
Like, he didn't, he was alleging all sorts of stuff, but he didn't do his monthly reporting.
Oh, yeah. Well, okay. So you can default on a loan if you bought it as a primary residence, but it was really an investment property. So it's not that he wasn't paying. He found out some outside way to try and take the property back. Wow.
Right. He wanted the business. That's what he wanted. So, I mean, and we fought this in court for a year and a half. I mean, 2 years, and settled on the eve of trial because it was a very aggressive plaintiff or defendant. So, So there are certain flags that you look out for: high interest rates, non-referrals. If you go on the internet and you search for, private money, and then you find a guy and fill out a form online and then get a deed of trust on your house, and you probably get what you deserve. So leverage the relationships that and talk to a lot of people. The challenge is that people that wind up being in that situation are usually behind the 8 ball to begin with, and there's usually a time crunch.
Well, I appreciate the advice here today, Ted, AJ. As we have said before, and I'll say it again right now, if you are buying a house, right, conventional financing, or maybe you're refinancing, or you're getting into commercial real estate, or maybe you're doing something that's a little bit more creative, like investing, flipping, you need hard money, whatever it may be, you got to remember that a lot of the people that are involved in the transaction, they earn a commission, and there's nothing wrong with that. But having a legal analysis, having a real estate attorney like AJ Gupta, it's just so important for everything you could possibly do when you're talking about this big of an investment with this much money. So, AJ, I appreciate you coming in here. Ted, important stuff. People need to know about it. It's being used for a lot of the things happening in the marketplace, and we're glad to have you guys.